Welcome back to Click Capital, your go-to channel for the latest market analysis, data and charts. And as expected, the Fed hiked 25 basis points today. Got a little initial rally off that, but then we turned around hard in the afternoon, just going down to a 15-minute chart. And we finished pretty weak here, looking at the SPY and the Qs. Finishing on their lows with volume. I came in today 60% net short, had a great day, hope you did as well. Let's get right into it today and go over all the latest news, data and charts. So let's go check out the data and news, then we'll come back to the charts and do some price action analysis. Okay, so the Fed hikes by a quarter point, and the headline here says it indicates increases are near the end, but that wasn't really my opinion of what happened. I watched him, and if you actually read what he actually says the committee anticipates that additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. And the media is saying just because he didn't use the word ongoing increases, that might mean sooner. But he actually said the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Now, some people want him to change his inflation target to 3%, but he's sticking to that 2%. And he does acknowledge that recent developments are likely to result in tighter credit conditions. But he's saying they're committed to restoring price stability. And all the evidence says that public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain the confidence with our actions as well as our words. So he's holding firm. So I'll come back to this and we'll talk more about what this rate hike means and his language and how it's affected the price action today in all the markets. But let's just keep going through the news. So UK inflation just breaks a 3-month stretch of declines. Surprise rise to 10.4%. That is huge. And that's not too far off the 41-year high of 11.1% they got in October. So inflation is still well and alive out around the world. You know, all our major developed economies are in sync. They're very, very similar economies, you know, US and UK, service-based economies. A lot of the same, you know, inputs with food and energy, and, you know, similar cultures, similar central bank cultures as well. So this is still showing that the inflation in the world of developed economies is still well and alive. That's really a big number there for UK. Heat map today, pretty red out there. We did see banks, energy, some cyclicals and REITs and utilities come off. So I think some of these sectors might have been hoping for a Fed pause. Normally, Fed hikes, you know, bigger rates is good for financials, but with what's going on in this current environment, that's not. And now the yield spread between REITs and utilities has gotten wider, so they compete with bonds with yield investors. Saw Tesla come off, and a bit of mega cap tech. Nvidia was the only thing that really held up there, but we'll get to that a bit later as well. So we've got jobless claims coming tomorrow as well. New home sales, then Friday, durable goods, and James Bullard from the Fed will speak. So it'd be interesting to hear what he says. He's been hawkish for a while, so it'd be interesting to see if he keeps that tone in light of the banking crisis. And then we also got some services and manufacturing PMIs. So to give us some more reads on the jobs market and inflation. Fear and greed, yesterday we closed 38, only ticked down 1 point today, which was surprising. There's still, which I'll show you in a bit, there's still a lot of calls being bought and not many as puts relative, which is a really interesting dynamic in this market. And we can see that today in the options market. Apart from Nvidia, which traded a huge amount of contracts, 1.3 million, Tesla is 55% calls, Apple 54% calls, AMD 51, Amazon 57, GameStop 58, Bank of America 58, Google 65, AMC not, Meta 58. So quite a lot of calls being bought out there. Dark pools holding flat around 49%, which is slightly bullish. Insiders pulled back yesterday and sales outweighed them. So the Fed decision now in May, 5 weeks away, we're pricing in 58% chance of a pause, 41% chance of a hike. So we saw the bond market come off a little bit today, which was interesting. And still no news from Warren Buffett. I just filtered here for Warren Buffett news in the past 24 hours, doesn't look like he's stepping in to rescue the banks. So when the world's best stock investor doesn't want to take advantage of this, apparently, there's a lot of private jets flying out to Omaha, and what you would think is trying to present Buffett a deal, but maybe something still will emerge from this. Maybe he will get involved, but normally they act pretty quickly on these things, and so far, nothing from Buffett. Yellen, FDIC not considering blanket insurance for bank deposits. That doesn't sound good. Maybe she should have said they are at least considering it. So that's saying they're not going to backstop the whole system. You wouldn't think they'd have to, but so not a good sign. But I imagine they will backstop whatever they really need to. They can't change the whole FDIC overnight. Fed rate hikes will trigger a downturn of greater speed and magnitude than the Great Recession. So this economist is pretty bearish and saying it's not going to be confined to real estate, all the banks, and not going to be confined to corporate credit. It's going to be like 07, 08 all over again, except it's going to evolve even faster because of the speed and magnitude of the Fed's rate hikes. So I think there is an argument to be made there. There is a downside risk now. You've got ferocious Fed rate hikes, now banking crisis. There is the potential for this to keep evolving. So, but in the middle of the storm, it's hard to tell how long it's going to last for, really. But financial conditions are tightening. I think Jay could have actually paused today and would still go into recession because of this banking crisis. Banks are losing their deposits, and so they're going to tighten up on lending here big time, like they already had been before all this mess. And with credit cards already at record highs, this is going to choke growth in the economy, in the system. Credit is kind of, everything starts with credit. And I think what he's done is, he knows that, of course, obviously. He's gone ahead and done a 25 basis point hike because he really wants to, drop the hammer on inflation. So he's hoping that, because he was probably going to do a 50 basis point before all this mess happened, he's hoping with that his additional hike and the banking crisis, which will tighten lending standards, that'll have an effect on inflation, like a double whammy. So he wants to see inflation come down over the next couple of months, because it's going to be a lag in the economy before these, tightened lending standards show up and decrease sales and layoffs. So we might not see a tick up in unemployment for still a couple of months. But his actions here today in this banking crisis could help inflation turn around. But after what we've seen in the UK today, that's still not for sure. So this is still a really tough spot for the Fed and markets, with inflation still rampant and now banking crisis. That's a really tough spot to be. PacWest falls 15% after regional bank discloses deposit outflows. Additional liquidity was needed. So they had 33 billion in deposits on March 9 and 27 on March 20. So what's that? 33, 27. That's almost a 20% drop in a week and a half. And when does that stop? That's another bank run going on at PacWest. So the whole system is kind of like on the verge of a bank run, and especially nowadays where everyone's got an app, you can just withdraw all in 2 minutes. These digital bank runs can happen even quicker. So the regional banking sector is still in real trouble here, and we can see that in the price action of them. They even look at First Republic, just cannot pop up even when it's trying to be backstopped by the 11 biggest banks. It's kind of amazing to watch, actually. And China and Russia affirm economic cooperation for the next several years. So these two have a lot to benefit from each other. China's going to secure cheap energy from Russia, and maybe they help when they go to invade Taiwan in the next couple of years. And then Russia gets to, sell all its stuff to China. And because China's so much bigger than Russia, China's all Russia needs to sell to, because they're not selling to the West anymore. And it gives, Putin, the chance to flip the bird to America and the rest of the Western world. And, Russia, he really wants China to help military in Ukraine, but China's kind of going to play it off both because China still needs to sell to the West for their social stability, but wants to stay in the middle and get cheap energy. And I guess they both also have a lot in common, that they hate the West, and, they're both murderous dictators. They hate democracy. They both hate having a democratic country on their doorstep with Ukraine and Taiwan. And they seem to have these grand delusions that they're creating a new world order. And, they're trying to get everyone off the US dollar. And, China wants to be the number one superpower of the world. I don't think that's going to happen. Obviously, I believe in democracy, and I think eventually China and Russia will eventually be democracies, because that is the trend of all countries. We all move from concentrated power to more diluted power amongst the people, and all humans, no matter what your race, we all want that, human freedoms and freedom of expression and freedom of speech, freedom of economic gains, and the people of these countries will eventually figure it out. But this is all my personal opinion. I just find it funny. Both these guys both speak English, but they refuse to speak it to each other because they, seem to want to deny some realities out there. But anyway, I don't want to get too much into politics on this channel. What I want to keep it to is how does it relate to us as traders and investors. Basically, this could have a little downward pressure on the US dollar. They are going to do more trade in the Chinese yuan. And they're encouraging Africa and other little countries to do the same, creating their own little alliance here. But I think more importantly, puts a strong bid in gold with geopolitical tensions going forward. So I think gold has a tailwind because of all this, and maybe a positive for defense stocks as well, because the government's going to have to keep strengthening the military to counteract this new alliance that's going on. And lastly, in news, SEC charges Tron founder Justin Sun and celebrities Lindsay Lohan, Jake Paul, and a bunch of others as well, which is really good to see, because it's just an absolute joke that these Hollywood actors and other YouTubers like Jake Paul just completely exploit their followers. They have no idea what they're pushing, and others like Tom Brady as well. They're getting paid millions of dollars. They're getting paid millions of dollars to push this garbage onto their innocent followers. All their followers buy into it, lose millions of dollars, and they get paid millions of dollars from the even more dodgy crypto sellers. So what they're effectively doing is just taking money out of their followers' pockets and putting it into their own. So just complete greed, and it's just good to see the government coming down on this behavior. So all these people here as well going to have to pay up for their actions and, this financial promotion, So hopefully we've seen an end to that. But anyway, back to what's happening today. Let's go take a look at the 2-year yield. So we actually fell off today, 3.94. So what does that tell you? Does that mean the market was actually expecting a bit more? Like a 50 basis point hike? No, wasn't the case. We sold off in bonds. I think there was a bit of a flight to safety. We saw that in treasuries here today. Had a pretty nice pop up. But what I think the market is telling us here is that the Fed's hike, with tightened financial conditions, we're going to go into recession anyway. But the Fed hikes just made that probably even more certain and potentially more worse. So the bond market is actually saying the Fed's going to actually cut this year. We're looking at September at 461 and December at 429. Whereas Jay actually said today the market's got it wrong. Like, they haven't said that they're going to pause yet. But the bond market's saying, no, we're going into recession. You're going to have to cut. And typically in the long run, the bond market's more right than the Fed. So got to pay attention to that. And if the bond market is right, then equities are still way overpriced here. Look at S&P 39.36. March 10, that's when Silicon Valley went under. That's when the government stepped in, took over. So we're still above that on the SP. We were at a 38 handle after that news hit, and now we're still higher than that even after this big turnaround today. And it was quite the afternoon turnaround. We came off pretty viciously in the end there and put in a pretty nice technical pattern here. Like we bounced off this resistance line on the Qs I've had drawn in here for weeks, almost to the tick. And a nice big, inverted hammer here off resistance. And equal weight there looking pretty weak as well, especially mids and smalls being sold off hard here as well. A bit mixed on internationals because a lot of them closed early before the Fed decision. And when you look at Nikkei, Australia and China, that's all their yesterday session, so they haven't yet priced in what's happened in the US markets today. Over to volatility. Volatility initially came off hard during the day and just after the Fed decision, but then spiked into the afternoon and put in quite the reversal, just like equity markets did as well. Volatility still elevated above 100 here. Move index came off a bit, down to 142, and the premium between the move and VIX index, and that had gotten up really high, the premium of bond volatility over VIX volatility. And typically the bond market leads, so I do expect the equity volatility to pick up here, or bond market volatility is going to have to come right back down. Either way, I think the two are going to converge a bit more. And put call ratio in equities, it's just strange in this environment. Not many people are buying puts. There's still a lot of calls being bought out there. And breadth turned pretty negative here today. Stocks above the 50-day and 200-day turning back down. Over to spreads, we did see that turn off this highs here in cyclicals versus defensives. Equal weight still getting hammered down. Mega cap tech still did hold up better today, but high beta came off a slow volatility. And we can see that in growth and the Qs with the mega caps holding off. And smalls just getting slammed relative to bigs again. We're just right down here, walking the line on the buy-sell band. And we saw the yield curve jump today as well. So still holding up around negative 50. And high yield versus treasuries came off. And here's that flight to safety, I think, that we saw today. And high yield just holding flat after initially rallying pretty good in the session. It came off pretty hard. Dollar dipped down pretty good today, coming back down to this support level around 101. I think we could be going back into this downtrend, so I think this support might be taken out. And Bitcoin had quite the turn here today. So it had been looking good with everything that's been going on, but with risk coming out and those higher rates, we've come off pretty hard there in Bitcoin and Ethereum. With that dollar down, managed to prop up commodities a bit. Copper up a little bit, just a bit above its 50-bar VWAP. And gold had a nice kind of bounce back after that bit of a pullback yesterday. I still think this is a valid breakout. Big momentum thrust here to new highs on really big volume as well. Silver had a good day as well, breaking out to new multi-week highs. And over to stock sectors. Everything, gold miners was up. Everything else, red. Lots of red out there. ARC's off 4.8%. Discretionary off 2.2%. Biotech got hit hard again as well. And regionals. Look at regionals coming down to their lows. You've heard me saying they've been trying to make a bottom here, but I'm not sure if it is, and it doesn't look like it now. We really need a bounce here for this to be a bottom on the regionals and financials. Didn't like that rate hike today. It's just putting more pressure on the banks and their balance sheets, and just probably adding to this crisis a bit. And REITs as well, with that higher rates. We actually sold off really hard here on REITs and made. And just looking at defensive, still pretty weak down here. Now, typically, if this were the end of the bear market, you'd see defensive sectors rally, and the growth sectors like discretionary, tech, and communications, you'd see them fall off hard. So this is the opposite of the end of a bear market, which tells me this is still most likely a bear market rally overall. But we'll get back to the indices at the end. BlackRock came off today. So did JP Morgan pretty hard. And Apple, kind of an inverted hammer there up on this resistance zone. So we might have reached a little bit of a peak here in mega cap tech. I mean, if you look on a yearly chart on Apple, we're still up 21% year to date. I mean, we're only in March. We're still in Q1. We're up 21% year to date on Apple. I don't think that's a sustainable rate especially in this environment. Just had rates hiked. Tech doesn't like higher rates. Jay Powell didn't say he's going to pause it just yet. Still said, got to keep the gas on inflation. Not even a banking crisis can stop him from hiking. So I don't think that's good for tech, and I think tech could be looking maybe a bit of a swing short here. We still might move a bit higher in this growth rotation trade that we've seen in tech this year, but for now, Apple and some of the others look like they may have bounced off a bit of a resistance because we are a bit overbought here. And I actually took a short in Google today as well, above the buy-sell band here on our indicator, and came up to this big resistance zone that I've had drawn in here. So I've still got a little bit of short tech, but look at Nvidia and semis. We made high and high low on Nvidia today. Nvidia actually got up to 275. I hope this goes up to 300 because I want a chance to short it at 300. I think it would just be great risk reward on a short up there, and it's just so overvalued. I mean, now 650 billion market cap, PE of 150, and we saw sales come down the last couple of quarters. We had lower sales than the previous year, so this is just a crazy valuation. This AI hype train's got so much legs to it. We did get short in here, but we had to cut it off at about 250. And this still could run higher, so hopefully it does. I would love it to go on a huge run above our top of our buy-sell band here, and when you start seeing like people saying, oh, this time it's different because it's AI or some other really cool sounding story, that's a great sell signal. So we might get to like 298 just before 300 or just above it around this psychological level. But around here, I'll be looking for price action to stall out. It is kind of already building a bit of divergence here on our hidden divergence indicator, but I want to see it get really stretched here because we're still kind of pumping up higher on volume here. So even in the face of today, it's pretty strong price action with what happened today. So, and this is just picking up more and more longs. And if you think about crowd psychology, when it's just picked up so many longs, and a lot of it will be, hot money. And when it peaks, when it does come off, it'll come off so hard because everyone will hit the exit door like there's a fire in the room, and that's what it's going to cause it to eventually topple. So hopefully it does rally up towards 300, even higher for a good short up there. Netflix came off pretty hard today, 3.8%, and so did Tesla, a bit of a turnaround from yesterday. And meme stocks, we actually saw GameStop. I think we got up to almost 50% after hours yesterday. And once again, the meme stock crowd just cannot get their timing more worse. If there was ever a better opportunity for a rug pull, it's when GameStop's up 50%. So that was sold off really hard from the open today. Admittedly, they did have had a better quarter. They actually did surprise pretty good and actually had a profitable quarter. But I mean, 16 cents, it's still, if you extrapolate that out, to an annual run rate of say 16.32, 64 cents at a $23 stock, that's still really priced for a company that is in secular decline, mostly still losing money over the last 5 years. A physical store that sells games with a market cap of 7 billion just doesn't sound right. But who knows, maybe they can completely turn around and get more into the digital world. But for now, I think it's just more of these kind of dead cat bounces that we keep seeing in these meme stocks. Every time that they perk up, they just get sold off hard. The meme crowd gets in, gets excited, and then hedge funds come in and just sell it hard. So we can see a lot of that action in a lot of the meme stocks. They pop up, then they just get hit hard every time, just about. Active today, Nike. They actually came in a lot better on EPS and revenue, but the market sold off. I think they gave poor guidance, and so the market initially got up with its earnings, but it came off pretty hard today, 4.8%. And look at this First Republic coming down near lows. So they're really going to try and backstop this. Wouldn't be surprised to see this being taken over by one of the bigger ones, or a sale or something. They're going to try and The 11 banks have got a 30 billion in this, so they've got a big vested interest. So has the Fed, so they're going to really try and plug the hole on this one. But now we've got PacWest, lost 20% of their deposits in the last 2 weeks. This thing could be next. The price action in these just says, this is still an ongoing storm. And now with the rate hike, that's just add further pressure to their balance sheet and mark to mark. And look, you can see that price action today in the big financials too. Look at Bank of America trading down near its lows. Same with Citigroup, and Wells actually took out its prior week lows as well and finished really weak down there on its lows. So that's not good price action for the banks and the overall market and economy as well. Banks are in trouble. That means, credit and lending is going to tighten. That's going to affect the economy, but there's going to be a lag on that. So there'll be a few months before we see that affect, like sales and unemployment. But the bond market is saying that's exactly what's going to happen. We can see that with that big jump in the yield curve, which typically indicates an imminent recession. And then stock markets typically sell off hard going into recession. And then they typically bottom before the economy by about 6 months as well. So the stock markets are kind of always, 6-9 months ahead of the economy. We can see we're back to, you look at the Fed Fund futures in September, we're back to where we were here when the market's disagreeing with the Fed. And that was going on for a few months. The Fed's like inflation, we need higher. Market's like, no, it's going to be a recession, you need a cut. Then all of a sudden, there was a hint that we're going to go 50 basis points in the markets. Like the market was like, whoa, we didn't expect that. Really, do we have to go 50 basis points in inflation? Then all of a sudden, banking crisis, complete repricing. And we're at divergence again with the Fed saying, no, we're probably going to go up here, towards September, maybe 5.25. And the market's like, no, we're going into recession. You're going to have to cut. By Christmas, you'll be cutting. And I mean, it makes sense. The banks are in real trouble now, and unemployment at 3.4, 3.6 is, kind of peaked. Credit cards maxed out, and we can see, retailers talking about a weaker upcoming consumer and so on. While we've still got inflation and a Fed hiking rates. So I'm like 80% sure we're going to see the recession this year, or at least moving into it. Towards the end of the year with unemployment getting above 4%. And if that's the case, then risk assets like growth stocks, cyclical stocks, and tech stocks and highly valued stocks with a lot of debt should sell off pretty hard. So let's take a look at the markets overall. SPX, we've turned pretty good here after tagging the 50 bar VWAP, and the Qs as well just bounced beautifully off this big resistance line we've had here for a while. We've seen some turns. I've had this line drawn in here for weeks. Haven't changed it. And bounced off it pretty good today. And if you look at smalls, what's happening there, and then in regional sector and financials, the biggest risk in the market now, the price action in that is still looking really weak. So I think it's still a really good bearish setup here. And I'm positioned as such as well. I was watching today, if we go down to a 5-minute chart, this is when the Fed did the decision there. Initially, the market liked it, and the market was kind of bouncing around all over the place. And we shot up again here, and I was watching it here on this resistance line right when it hit it, and above the buy-sell band on the 5-minute, and on weaker volume as well. And this is when I was just like, there's just no way. We've just hiked a rate. And they're saying like, oh, he's gotten a little more dovish, and I listened to him, and he didn't sound more dovish to me. He sounded like, we've still got to get on top of inflation. So I just couldn't buy it. There was just no way I was getting long. So I added more shorts around here, and I just could not believe this rally. But with the confluence of being overbought up here on the resistance and low volume, it was just too enticing not to go max short. So I'm 100% max short. Finished the day really good, and I'm looking for a further pullback, especially in the Qs, to come down now that we've got a Fed rate hike, and with what's going on in the banks as well. I mean, it's crazy. The SP500 is still above where, like if I'd told you 2 weeks ago back here, we're going to have the biggest banking failures since the global financial crisis. You're going to see Credit Suisse get forced to be sold for peanuts to UBS, and you're going to see Signature and Silicon Valley and all these go under, bank runs on all the other ones. A lot of fear of contagion, credit markets seizing up, liquidity drying up. Oh, and by the way, the Fed still hiked it as well. You would not have thought that the market would be higher, a week and a half later. And, especially with what's going on in bond market volatility, and VIX as well, still elevated up there. And we just tagged our 50-bar VWAP on SP500 today. So I still think equity markets are a bit mispriced here compared to pretty much everything else. And so I still think it's a compelling risk reward on short here. So I'm 100% net short. I've pretty much been net short all this way through here, except for this day here. I think I got 20% net long, and I think I got flat down here. But I've pretty much had a net short position for weeks now. And I still think I'm going to keep net short for some time. I just think that the risk reward is on the downside, and I think there is a recession coming, and if there is, then equities are going to sell off hard going into it. And I think we will at least retest these October lows down around here, 3,500. But I would not be surprised if we do move towards a recession later this year for the market to price that in, and we go more down towards 3,000 on the S&P 500. I know a lot of people think I'm crazy for that, but that's just my speculation. That's just my opinion based on everything I see. I think this market's looking incredibly weak, and with everything that's going on, I still think it makes it a good short up here. And looking at breadth and everything else, that a new bull market is just not there, like some people are saying. But again, this is not financial advice. This is just my opinion and my analysis that I'm just sharing with you what I think and what I'm doing. And as always, you always got to stay agnostic and keep an open mind, because anything can change, anything can happen, and always got to have stop losses. But for now, I'm happy to be my maximum amount net short, 100% net short going into tomorrow, and looking for the next leg down. Okay, guys, that's all I got for you today. Thanks very much for tuning in. I appreciate all you guys that tune in every day and hit the like button and drop comments every now and then. I really do appreciate it and enjoy making these videos, and so I hope to see you back again tomorrow afternoon. Okay, cheers.